Hello and welcome to this webinar on intercompany agreements. My name is Paul Sutton from LCN Legal, and the aim of this webinar is really to give an introduction or a refresher on intercompany agreements for transfer pricing and what's involved in them. And I'm just going to let in other people who are joining. And so what we're going to do is go through a couple of case studies, so using Coca-Cola and Singapore Telecom as mini case studies to illustrate how agreements fit in. I'll give you the 10 commandments, if you like, the ICA basics that you need to think about in relation to your own agreements. Also take you through the framework that we use, the 4+1 areas of health check for intercompany agreements, as well as a typical process for intercompany agreement projects. And then hopefully at the end we'll have some time for Q&A and discussing key action points. So just a couple of housekeeping issues as we join, or before we start. Firstly, we are recording this session, so please don't disclose any confidential information in your questions or anything like that. Second thing is, if you do have questions, please use the chat function in the webinar pane, and I will do my best to get to them as they arise, or if not, then it will be at the end of this session. And the third thing is, if you would like copies of these slides after the event, then please just drop me an email and I'll be very happy to share them. So just a word about me, about LCN. So we are lawyers. We're not tax or TP advisors, so we don't advise on transfer pricing. We don't do comparability studies or functional analysis. It's purely the legal aspects, in other words, intercompany agreements, corporate structures, the legal aspects of group reorganizations. My background and the background of all our lawyers at LCN is that we are corporate lawyers. So I was a corporate lawyer for around about 9 years before I joined KPMG's law firm in London. That was back in 2001, and that was my introduction to the world of transfer pricing and the legal implementation of tax-sensitive structures. And one of the things that I noticed is that there seems to be this huge gap in understanding or information maybe between the transfer pricing community and the legal community as regards what it actually means to implement transfer pricing. And that is the area that we've really focused on as a firm. And so although we happen to be based in the UK, actually it's a global business. It's a global set of clients that we serve. So by way of context, there are lots of different ways of looking at transfer pricing and transfer pricing compliance. This is just one view of things. From my perspective, the goal or the trophy here is robust TP positions. In other words, the whole purpose of the transfer pricing community and lawyers like us who support that are to help the corporates survive tax audits when they happen. So it's to withstand tax and transfer pricing challenges that may happen sometime after the relevant transactions. And in order for those TP positions to be robust, certain elements need to be in place. So in this picture, you can see the table has 4 legs. So these are 4 aspects that need to be in place in advance of the relevant transactions in order for the transfer pricing policies and price setting policies to be able to withstand challenges later. So those 4 aspects are obviously FAR, functional assets and risk analysis. Another key area is entities, because of course, if a corporate doesn't have a handle on which legal entities it actually has in its group and which entities are doing what, then any transfer pricing policies are going to be flawed. Obviously, the agreements are a key part of that in defining and delineating and implementing those transactions. And of course, comparables and price setting. And the main point that I want to get across here is that that comparables leg in terms of setting pricing in advance only works if the functional analysis is clear and robust, and the agreements actually support that, as opposed to contradicting the functional analysis. Because if there is a contradiction, then immediately the taxpayer is going to be on the back foot when it comes down to those later tax challenges or tax reviews. And of course, on top of that is actual conduct in real time during the relevant financial period. In other words, you can have the best functional analysis in the world, the best agreements in the world, but if the corporate doesn't follow that in terms of its actual operations, then that TP and that legal work is unlikely to be of much value. So that's really the context that we're trying to work on here together. So this is the first of two mini case studies, just to really illustrate the role of intercompany agreements. And I'm sure you've come across both of them a lot in your professional work so far. So the first is Coca-Cola. And as you know, a key focus of that decision was the relationship between the Coca-Cola company at the top there and related US entities, and the so-called supply points. So these are local entities in places like Mexico and Ireland, which actually manufactured the syrup or concentrate for the relevant drinks. And that concentrate was then sold to third-party businesses, the bottlers, which actually produced the fizzy drinks or whatever, and then sold them to retailers. And during the relevant period, which is 2007 to 2009, as you probably know, the group operated a kind of profit split, which was referred to as the 10-50-50 method. And that said, in effect, that the first 10% of gross sales got allocated to the supply points, and any additional profit over and above that was split 50-50 as between the local supply points and the Coca-Cola company or the US-based entities. So that was the scenario, and that was the challenge. What's really interesting is the degree of attention that the US tax court placed on intercompany agreements and identifying a number of issues with them. First issue, you could say, relates to the entity's leg of the table. So it found that the US tax court found that the agreements were inconsistent, outmoded. In other words, it hadn't kept pace with the corporate structure of the group during the actual relevant period. Second point was in relation to pricing. So the court found that many of the agreements made no reference to price at all, and actually none of the agreements encapsulated the 10-50-50 profit split method that the group claimed it was operating. So there was a failure of implementation there. But probably the key factor which contributed to the weakness in Coca-Cola's position was in relation to intangible assets. So clearly, from an economic perspective, if supply points are going to receive more than half, or potentially more than half, of the profits in this sort of transaction, you'd expect that they would be owning valuable marketing intangibles or some other intangible assets and contributing to that value creation. And one of the things that the court found was that the agreements were consistent on just one point, which was actually ownership of IP. So all the agreements in place during the relevant period actually said that all the intellectual property, all the intangible assets relating to the activities were owned by the US and not by the supply points. And one of the comments that the court made was, this is actually a one-way street. It's not a two-way street. In other words, the taxpayer had complete freedom as to what agreements it put in place. And having exercised that freedom and put in place those agreements, it's not for the taxpayer to disavow those agreements and say, oh, sorry, we screwed up, and let's just look at an economic analysis of the event. The taxpayer doesn't get to do that. It's only the tax administration, the IRS, which gets to play that kind of economic analysis trump card. And I think that's one of the reasons why this case from November 2020 has sent such shock waves through the TP communities in the US and globally. in that it's really blown away a lot of the complacency that people used to have about agreements and the relationship between agreements and economic analysis. In other words, if you've got the agreements wrong and it's reflecting something that you don't intend, then it may well be difficult for you to recover from that position. So really, our joint aim here is to avoid that kind of situation. Second example I want to give is the Singapore Telecom Australia case. So this was a decision in December 21, and it involved a transfer pricing challenge to interest payable under certain loan notes. And you can see in this diagram, it actually related to 5.2 billion Australian dollars worth of loan notes. And this structure was put in place immediately following an acquisition by the group. So the Singapore Telecom Group acquired a business from Cable and Wireless, which was then renamed and became SOPL in that structure diagram. So what we're talking about here is the debt structure between the new holdco of that operating group, so the holdco being called STAI, and an intermediate holdco above that called SAI, which provided that debt funding. And you can see from the timelines, the structure was put in place in 2002. The structure was varied in the same year, but also in 2003 and 2009. We don't know when the investigations by the ATO in relation to that interest deduction actually started, but we do know that the first adverse TP assessment was made in 2016. And then, of course, the decision came in 2021. So immediately you can see that there's a basic challenge there, which is record keeping. So the situation that a group was trying to defend the transfer pricing in relation to structures that were put in place maybe 10 years before the challenge was actually made. In terms of the relationship between the transfer pricing analysis and the contractual terms, what is really clear from the judgment is that the assessment and the pricing of the loan from a transfer pricing perspective rested on two main planks. So one plank is the credit rating of the borrower, taking into account the implicit parent company support. That's one aspect. And the second aspect was to see the terms of the debt as regards interest and repayment terms and so on. And so I guess it's obvious really, but you can't price a loan transaction until you've delineated it. I think in financial transactions, loans, out of all intercompany transaction types, it's very difficult to deduce loan terms just from conduct. And therefore, it's in many cases, there is no clear reference point other than the contractual terms or maybe correspondence, but that's obviously much weaker. So that's the kind of central point here. The subsidiary point, which became actually really quite significant, and I think it means that we've again got to review how, as a community, we protect our clients, is that the court was really struggling to understand the commercial rationale for the structure as it was put in place and as it was varied during the life of the structure. So it's clear from the court's commentary that the group had failed to produce a contemporaneous or any record of that commercial rationale. And that's apparent from the fact that the court was having to look at exchanges of emails between Singapore Telecom and its advisors, in EY in that case, in trying to understand why it could possibly be considered to be in the interests of the relevant entities for the debt to be structured as it was, which ended up really quite complicated with an interest-free period with a premium on interest rates and fixing what was previously a floating interest rate. And I think that means that for us, it's not just about, and when I say us, I mean us as the entire community looking after corporates. It's not just about making sure that agreements in place. It's not just about having appropriate transfer pricing policies. It's also documenting the commercial rationale, the decision-making process, particularly for more complicated transactions like this. So as I mentioned before, if you do have questions, please feel free to use the chat function as we go along. Otherwise, I'll just go through the basics as planned. So here's what you might refer to as the 10 commandments of intercompany agreements. It's a fair amount to cover, so I'll have to do it relatively quickly. Point number one is that agreements need to be clear and unambiguous. I think in the past, maybe 10 years ago, 15 years ago, there was a view maybe in the tax community that if you didn't say anything concrete, then you could never be proved wrong. So this idea that agreements shouldn't contain pricing clauses or should just refer to prices to be agreed between the parties, or the idea that you can fudge the obligations or the nature of the transaction. I think there's no doubt at all that that does not represent best practice, and that what we're looking for, what tax administrations are looking for, is a transaction which is clearly and unambiguously defined and implemented, and with appropriate pricing policies to back that up. And that principle is reflected in local guidelines. For example, Austria's TP guidelines issued in November last year, which actually have a specific requirement for agreements to be clear and unambiguous. Second point, number two, agreements should be as short as possible. This is not a legal requirement. It's not mentioned in the OECD TP guidelines. It's just a practical point. The longer the agreements are, the less likely they are to be read by the relevant people, the relevant stakeholders within the organization, the more likely they are to have maybe operational provisions which are not being followed in practice because they're impracticable, and therefore they undermine the integrity of the agreement. Or maybe worse than that, the agreements will contain specific operative provisions which have the effect of allocating risk or modifying the ownership of intangibles in a way that contradicts TP policies. So what we're saying is, as best practice, keep agreements as short as possible. They still need to be fully legally binding. They still need to express the key points, but we need to avoid unnecessary verbiage there. Number three, aligned with the contracting model and legal environment. What do we mean by that? So it's basics such as distribution strategy. So if, for example, you have local sales entities, then perhaps from a TP functional perspective, you're describing, or your functional analysis is talking in terms of their role in the supply chain and what support they provide the principal. That is completely valid. But if from a contractual perspective, those local entities actually sign contracts with third-party customers, then from a legal perspective, it's not a supply of services from the local sales entity to the principal. It's actually a distribution agreement or reseller agreement. And it's vital that the agreements need to actually match the reality and not some kind of alternative model of reality as per TP policies. What do I mean by legal environment? I mean things like regulatory restrictions on the supply of goods and services, for example, financial sector, for example, pharmaceuticals sector. So the contracting model, the legal agreements, the supply chain obviously needs to work in the context of the wider legal environment, and then the transfer pricing policy needs to work within those constraints. Number four, obviously, the agreements need to align with TP policies, and we'll address this later in a bit more detail. Number five, align with other needs. So this is the point that intercompany agreements are not just about transfer pricing compliance. They also have important implications for customs, VAT, GST, asset protection, IP protection, and so on. So it really does require a cross-functional approach to get them right. Number six, aligned with directors' duties. So one of the reasons why I think Singapore Telecom got into such a mess is that they just completely started off on the wrong foot. That $5.2 billion or Australian dollars worth of debts in its original form was actually repayable on demand, and clearly that made no sense. So that's clearly not an arrangement that the directors of the borrowing entity could properly approve from a liquidity perspective. And I think that issue and that failure to align the agreements and the TP policies with the fundamental requirements of corporate benefit directors' duties really caused a lot of the problems that came up later. Number 7 is concluded in advance. I think there are two main reasons for that. Number 1 is the issue of risk, which we'll talk about in more detail later. So as we all know from our personal experience and from the OECD TP guidance, risk only has a meaning if there is uncertainty. In other words, on a forward-looking basis. You can't allocate risk after the event when outcomes are known. And therefore, to the extent that the agreements are critical in documenting and implementing the allocation of risk from a contractual perspective, clearly the agreements need to be in place in advance and not after the event. So that's point number 1. Point number 2 is relates to local tax rules. So under a number of jurisdictions, including Austria, for example, there's the general presumption that unless agreements are concluded in advance, then the relevant tax deduction or expense deduction will be disallowed. Number 8, documented commercial rationale. So this really links in with the Singapore telecom case, and that increasingly it's important to document the governance process and respecting the fact that agreements, intercompany agreements, are genuine agreements. They have an impact on the position of legal entities. They have an impact on the ability of directors to show that they have complied with their duties, and therefore the personal liability exposure of directors, and therefore the commercial rationale needs to be documented in a reasonable way. Point number 9, stored in a comprehensive central archive. I think COVID has really been a catalyst for that. Previously, there may have been a tendency for copies of agreements to be held by local tax managers. COVID, amongst other things, has shown that that is not actually workable. But the fundamental thing is that the tax function needs to take ownership of its agreements. And the only way of doing that is to have a comprehensive central archive of intercompany agreements, which can be reviewed, accessed, and maintained. And then point number 10 is obviously agreements are not a set and forget type of arrangement. Again, we've got Coca-Cola as the cautionary tale on that, a portfolio of agreements which had not been kept up to date, which was not aligned with the group as it actually existed, and therefore was a liability as opposed to an asset in relation to surviving TP audits. So those are the 10 ICA basics. I'd like to drill down on alignment. What do we mean by alignment between intercompany agreements and TP policies, and what are we actually looking at when we're health checking agreements? So maybe if your advisors, if your clients ask you to give an informal view on agreements that they already have, or maybe if you're in-house and you're aware that the portfolio of agreements you have may be somewhat old, what is it that you should be looking at? So what we're offering here is a potential framework that you can use. So as you can see, there are 4 key areas of alignment. First key area is delineation of the transaction. In other words, does the transaction as documented in the agreement, and in particular the key obligations of the parties, does that match the description of the transaction in the TP policies? Because if they don't obviously match, then it means clearly you're going to be on the back foot when you're explaining what the transaction actually is. Number 2, risk allocation, and we've got another slide coming up next on specific clauses regarding contractual allocation of risk. Obviously, not every risk is material, so the starting point here is probably the TP analysis, so your analysis of which are the economically significant risks in relation to the supply chain of the group, and then looking at the intercompany agreements and making sure that they implement that contractual risk allocation. Number 3 is ownership of IP and intangibles. So obviously we have the Coca-Cola example to really illustrate that. And clearly the TP term, intangible assets or intangibles, is extremely broad. And so when you're looking at alignment between TP policies and agreements, it often means that you need to unpack those definitions, such as concepts like marketing intangibles, and you need to go through the thought process of what does it actually mean here? Because that could cover local trademark registrations. It could be local, it could be product IP like design rights. It could be ownership or control over customer contracts. It could be customer data or even user data. So it could cover a number of different things. And from a TP economic perspective, checking alignment often means drilling down a little bit more into what exactly are you talking about? Where is the economically valuable asset here or the valuable function here? And then checking that against the agreement to see how those asset types from a legal perspective are actually dealt with. Fourth key area is pricing. And clearly here, we're just looking for direct alignment between the pricing clauses in the agreements and the relevant TP policies. So if it's a cost plus arrangement, it's about defining the cost base, defining the cost plus markup, and perhaps also the allocation key if that's relevant. If it's a target margin arrangement, then maybe there's an upper range and lower range of that target margin. So again, it's making sure that the contractual functionality actually meets and supports the TP policies. And specifically, you're looking at statements in your TP policies regarding the outcomes for the parties. So for example, if you're saying that a limited risk distributor is guaranteed a minimum routine return, the question is that true or not? And often the only place where you can look for that verification is the agreement. So you do need to look for specific clauses there. So those are the four key areas of alignment. When it comes to health checking agreements, there's also the everything else category. So typical things that agreements fall down on are things like the parties. It's not uncommon for us to review agreements where the entities, the parties, are actually wrong or the wrong way around. Are the agreements actually signed? Are they actually dated? Has there been an attempt to backdate agreements in such a way that is actually a fraud? What is the length or duration of the agreements, and what does that mean in terms of risks playing out between the parties? And this is something that the OECD's COVID TP guidance actually talks about at some length. And are there inappropriate provisions that just create unnecessary administration, or if those provisions are not being followed in practice, do they actually undermine the entire integrity of the transfer pricing documentation? So those are some of the headline issues that you need to look at when you're health checking agreements. So let's look at a little bit more about risk allocation clauses in the context of intercompany agreements. And as I said before, what we're really trying to do here is work backwards from a tax audit situation. So this is a tax audit or a tax challenge that may happen 3, 4, 5, 6 years down the line, so after the relevant financial period. And at that point, clearly the tax inspectors are going to be asking for copies of TP policies. They'll be asking for agreements. They'll be looking at what the TP policies say about what are the economically significant risks for the group, for the entities involved. And they're going to be looking at the corresponding clauses in the agreements to see, has this actually been implemented, or was it just a nice idea in the TP policies which actually never found reality? So unfortunately, the way that most agreements are drafted is that individual clauses aren't neatly labeled by reference to risks. So it does mean that you need to look at the agreement as a whole. You need to read the agreement as a whole in order to understand the overall effect. So the classic example of that would be inventory risk. And as many of you know, in the 2022 OECD TP guidelines, there's a mini case study which is actually carried over from the 2017 version, which is about the impact of one single clause in an intercompany agreement about inventory risk. And this is actually a buyback clause. So the scenario here is, if you imagine the relationship between a principal or a supplier and limited risk distributors. So this principal is basically saying to the distributors, please, could you buy stocks of our products? But don't worry if you can't sell them all, because if you end up with unsold stock, we will buy it back from you at cost. So that's a buyback clause. And that's one way of moving the inventory risk from where it would sit by default, which is with the distributor, back up to the principal. And in that OECD example, the presence or absence of that one single clause makes a 20% difference in pricing. So that's the kind of thing that you need to look out for. And in terms of inventory risk and what other clauses might be relevant to that, you might also be looking out for minimum purchase obligations on the part of the distributor. So does the agreement contain that kind of provision? It's not at all uncommon, especially where the group has mistakenly used or misguidedly used a third-party agreement as the starting point. One of the duties of the parties on termination, so often in third-party distribution agreements, the termination clauses include obligations on the distributor to destroy unsold stock, while clearly that would be inconsistent with the idea that inventory risk is borne by the principal, and also liability caps and liability exclusions. So that's just talking through one category of risk and how that may play out or need to be reflected in the intercompany agreement in order for your statements in the TP policies to be true and not fiction. So hopefully that's given you some direction as to what you need to look at there. So I'd like to move on and offer a framework really for wider ICA related projects, whether you're in the role of an advisor or an in-house lawyer or tax professional. So this is the approach that we take ourselves to typical transactions. And we divide these projects into 5 main stages when we're designing new intercompany agreements. So the first phase is high-level scoping. So often the starting point is the draft TP policies, or maybe the previous TP policies if they're not being materially changed. And we're looking at those from a legal perspective to say, well, what are the key intercompany transaction types that are reflected in those policies? So it may be 3, 4, 5, 6, 7, depending on the complexity of the group. So here we're talking about things like central support services, R&D services, limited risk distribution, full risk distribution, IP licenses, intercompany loans, cash pooling, and so on. So it's really from a high level perspective, listing out those transaction types and understanding the subject matter and the parties. And if you're listening and you're a TP advisor and you don't routinely create this kind of table as part of the exec summary of your TP reports, please do that, because it would make everyone's life a lot easier and would avoid having to rewrite TP documents. So that's stage number 1. Stage number 2 is detailed review. In other words, we're looking into the TP policies or draft TP policies in more detail to look at the statements made as regards functional analysis, intangible assets, risks, and so on. So really drilling down there, looking at the group structure and the relationship between the parties or the group entities, looking at existing intercompany agreements, maybe third-party agreements, so that we properly understand the contractual flow there, and also looking at ownership of IP assets and intangible assets within the group, because obviously whatever agreements are put in place now need to be aligned with the legal environment and the legal reality, if you like. Third stage is drafting. So what we're doing here is we're creating a first discussion draft agreement for each of the individual transaction types. And often in this phase, we'll work initially directly with the transfer pricing advisors or transfer pricing professionals involved, so that we have an agreed form between us before it's shared for more wider comment. So we're effectively creating a template agreement for each of the key transaction types. Phase number 4 is finalizing those template agreements. So this includes the fact that we touched on before that agreements are not just about TP. There'll be a range of different stakeholders within the group, including, as I mentioned, customs, regulatory, compliance, IP protection, data protection, and so on. So when we're working alongside a group, we're encouraging them to identify all the key stakeholders, make sure that their needs are taken into account before we finalize those template agreements for each transaction type. Then step number 5 is the implementation phase. So that means localizing those agreements where needed, so taking into account local sensitivities, whether they are interest rate caps or tax withholding tax sensitivities, or maybe regulatory sensitivities. It is rolling out those agreements, so actually populating the individual agreements with the relevant data. And crucially, it's also creating briefing notes for directors, and that's to address the commercial rationale point. And then last but not least, in terms of the implementation stage, is making sure that the outputs, so the actual signed agreements, are actually stored electronically in a central archive. So we're laying the groundwork for that audit readiness going forward. So that's an overview of typical stages for this kind of project. So I'd like to open up for questions in case you do have any. Please feel free to use the chat function if you do have specific things, specific issues that you'd like to raise. If any of the questions that we put up here particularly resonates, then you can just type in that number. Otherwise, I will choose a couple at random, which regularly come up just to get the discussion going. So let me start with a question that is often asked, which is number 8, which governing law should apply to intercompany agreements. There's often a lot of confusion about that, but the answer is really very simple, or usually very simple. So generally speaking, any given corporate group will choose the same applicable law to govern all its agreements. So if it's a Swiss headquartered group, then often it would be natural for that group to choose Swiss law to apply, irrespective of the location of the different counterparties. And that's on the basis that for any given agreement, clearly you can only choose one governing law, and therefore you might as well achieve that consistency. There are exceptions. So in some rare cases, there may be a regulatory or some kind of compliance need which would require a different governing law, but that is very much rare. And generally speaking, it makes relatively little difference which governing law is chosen, given that the main function here is to articulate and describe and implement the commercial nature of the transaction clearly. So often an agreement under Swiss law would look 98% the same as an agreement governed by English law or Australian law. So I can see there are a couple of questions. So first one, our agreements include a lot of references to or as agreed by the parties from time to time. Does this create risks? Really good question. So the starting point is the one of genuine substance, genuine agreements, and that means the requirement for agreements to be clear and unambiguous. What that means from a legal perspective, as regards pricing clauses and other clauses, is that there needs to be that reference point or that basis point of legal certainty. So if the agreement says, for example, that it's a distribution arrangement, the pricing of individual shipments is to be agreed between the parties from time to time, then clearly that's going to be unhelpful, and it may not tick the boxes for there to be an agreement at all. So it may be simply an agreement to agree, which is not legally binding. However, there's nothing wrong with specifying the default position, such as a markup percentage on a cost plus basis, but to say that that markup percentage may be agreed between the parties from time to time. So there's nothing wrong with that kind of arrangement. Point number 4, branches. So the issue here, of course, is that where it's a transaction between a parent entity in one country and its own branch in another country, parent entity in one country and a branch in another country, from a legal perspective, there's only one legal entity there, and you can't have an agreement with just one party. So that means that you can't have an intercompany agreement as such. Generally speaking, from a transfer pricing perspective, though, it's going to be helpful to document the transaction in a very similar way. There are two ways of doing that. One is to have some form of memorandum, which is not an agreement, not expressed to be an agreement, but which records the key terms of the transaction in terms of pricing and allocation of maybe profits and losses or whatever. So that's one way of doing it. Another way of doing it, which we would usually recommend, is to use the same form of agreement that is used for the same transactions elsewhere in the group, but to modify it slightly with a recital to acknowledge the fact that it is a document put in place between the same legal entity and therefore doesn't have the status of an agreement, but is put in place in that form for the sake of consistency and as an understanding between the management of the relevant branch and the parent entity. So that's usually the most helpful approach. Let's see. Is there? Oh, I can't quite read that. But ICA is for a group operating in jurisdiction where it's not yet required for TP purposes. Yeah, really good question. So in some situations, the driver for intercompany agreements is clearly transfer pricing, because the monetary risk attached to that, attached to non-compliance, is so obvious. In other situations, it's actually often legal or liability considerations which are the main factor. So a classic example would be cash pooling arrangements. So if you imagine, let's say you have a European cash pooling arrangement with the cash pool leader being in France and a number of entities in, say, Germany, Italy, UK participating in that cash pool arrangement and with a daily cash sweep. What this means, obviously, is that those participating entities are in effect making a loan to the cash pool leader, and those participating entities are therefore subject to liquidity risks as regards whether the cash pool leader will be able to repay those balances on demand. In addition, those legal entities in France, Italy, UK may be subject to local restrictions which affect whether cash is actually free cash and can be contributed in this way. So, for example, if a local entity has received COVID support in the form of loans or employment grants or something like that, there may actually be hard-edged legal restrictions on how the proceeds of that support can actually be used and whether it can be applied by way of loan in supporting an entity in a third country. And very often, the directors of those participating entities are concerned about those risks. And from that perspective, the agreements and the legal advice around those agreements are probably going to be more material than the transfer pricing risks, particularly if interest rates are low. So that's a long answer to a question which you could answer more shortly by saying it depends. We always advocate a risk-based approach. So assessing what are the transfer pricing risks involved, what are the legal or regulatory risks involved in those transaction types, and then deciding how you're going to document those arrangements accordingly. I can see that there's a vote for question 16. So how should intercompany agreements fit in the context of operational transfer pricing? We would see it fitting in three main points in time, really. One is if we're talking about a particular financial year, such as 2023. So one point in time in terms of the operational TP cycle is in advance of that financial period. So when it comes to price setting in advance, setting of TP policies in advance, and obviously the creation and implementation of intercompany agreements in advance. So that's on the basis that we discussed. The second touch point from an operational TP is monitoring for changes in the group structure during that period. So has there been a revised benchmarking of the transactions? Has there been a change in the group's operating model or contractual model? Have there been new entities, changes in the location of key staff, anything like that, that may need to be captured in the agreements? And then the final touch point is the look back, in other words, at the points that the transfer pricing documentation or the transfer pricing filings and corporate tax filings are being prepared for submission. At that point, it's a verification exercise. So again, to the extent that the TP filings, the corporation tax filings, rely on statements or facts which are influenced by the legal agreements, then it's a matter of verification. Can we actually still make those statements? So it makes sense to have a third control point there on a look back basis to say, can we actually say what we're saying, or are we really making an assertion which has no basis in fact? So that's how we would see things from that perspective. I can see that the comment saying COVID may have a huge impact on commercial agreements. Absolutely, and I think I'm sure most people on this call have read the OECD's COVID guidance in relation to TP. One of the things that is emphasised in that guidance is that agreements may need to be renegotiated, just as they may need to be renegotiated in third-party life. So it's not so much about relying on preset contractual mechanisms, because it's never possible to legislate for every opportunity. It's a matter of flagging up the need for that reconsideration to take place at all, working on or creating a proposal as to what are the next steps and what should the new state look like, and then documenting that not just in the agreements, not just in the TP policies, but also in the commercial rationale. So why would each of the legal entities involved agree to make the changes that are being proposed? Question number 7, thank you for raising that. How can we future-proof intercompany agreements? I think to some extent you can't, because as I said, you can't anticipate every change in the external environment. You can't anticipate every change in the group's operating model. But what you can do is you can aim to achieve the right balance between, on the one hand, making the agreements specific enough for them to actually have legal certainty, for them to be clear and unambiguous, and therefore to have substance. And on the other hand, avoiding being so specific that you need to amend and update the agreements every time a new product line is launched or something like that. So in general terms, I would say it's helpful to regard intercompany agreements as framework agreements, and to err on the side of keeping them simple, avoiding being unnecessarily specific in terms of listing out individual obligations, whilst also achieving that alignment. So I'm afraid it's one of those things where absolutely it's a balance, that there's not one correct answer to everything here, but certainly groups can help themselves by adopting a sensible approach. One other thing that will potentially help in terms of reducing the number of variations or the administration involved in agreements is what we call the Netflix style, or a Netflix approach for pricing clauses. So just as for us as consumers, when Netflix revises its pricing, we just get a unilateral notification saying that the price has been revised to X. And similarly, for domestic mortgages, where they're tied to a base rate, it's really a unilateral notification from the bank that the base rate has changed. For some transaction types, such as central support services, which are less significant, lower risk, maybe lower value add transactions, and less material from the perspective of both parties, then that kind of governance type approach may well be effective. And then question number 6, how should we deal with target margin arrangements? So obviously the classic example of that would be limited risk distributors, transactional net margin method basics. So again, the starting point here is that we do need to achieve legal certainty. We do need to make sure that statements in the TP policies, such as guaranteed minimum returns, are actually true, in fact, true in legal reality as well. So in many cases, what that means is that the pricing clause will say that the distributor will pay an amount, whether it's fees or prices of products, so such amount as will result in the distributor achieving a target margin within a defined range. So it could be, say, between 4% and 6%, something like that, whatever your benchmarking suggests. And so that means that the agreement will contain the functionality to say that in the event that the pricing of the outcome for the distributor during a year exceeds that upper end of the target return, then the distributor will pay an additional amount such as to bring it down to that upper end. And similarly, to the extent that the outcome for a distributor is below the bottom end of the range, then it means that the principal will pay an additional amount to bring it up. And as I'm sure you know, there can be VAT and customs implications about these true up or true down type arrangements. So generally speaking, and especially with physical goods, the group is going to be wanting to monitor those prices in real time pretty tightly during the course of the year, so as to minimize the need for post year end true up or true down adjustments. I can see a question: is there specific wording to be used in agreements for TP adjustments to mitigate VAT and customs risks? Unfortunately not. There's no one size fits all solution for that, because it depends very much on the nature of the goods, on the nature of the countries involved. For example, whether you're dealing with someone or a country like China, which may be very sensitive to fluctuations in pricing from a customs perspective. So unfortunately, not, and it's just one thing to address on a case-by-case basis, based on a cross-functional approach. So I'm going to just take one more question, or talk about one more, which is localization of ICAs, and thank you for raising that one. So generally speaking, when we're talking about localizing agreements, as I mentioned before, governing law is usually one. Usually a group will choose the same governing law to apply to the whole portfolio of agreements. So localization is not usually about governing law. More often it's about commercial or rather tax sensitivities. For example, withholding tax on management fees, or withholding tax on royalty payments, or interest rate caps, or those kind of considerations. So that may mean that in terms of the localization, you're not actually having to rewrite the agreements. You're just making specific changes to specific clauses, or perhaps specific variables in those clauses. The exception would be regulated groups. And of course, in the context of localization, you're also thinking about translations, and possibly the need for notarization or legalization of agreements, although that is pretty rare from a global perspective. I would say that translations are not as easy as you might think. It's relatively hard to find suitably qualified translators who not only have legal expertise, but also an understanding of transfer pricing. So when we work with translators, we're very, very careful about who we choose, but also it means that it really does make sense to get those translations in place in advance, as opposed to thinking that you'll be able to do it at the last moment. So I can see we're moving towards the end of the time here. I'm just going to leave you with some key takeaways out of all of this by way of wrap up. First key takeaway is if you're looking after a group or maybe multiple groups, and your group or groups don't already have a central archive of signed and dated ICAs, this is the #1 most valuable piece of advice that you can probably give them in relation to agreements. Get that set up. It doesn't matter whether it's SharePoint or some other form, but simply having that central archive is the beginning of understanding where you are, and therefore what are the gaps, what are the issues, and it immediately suggests a course of action to rectify those gaps. So that's point #1. Point #2, we've covered already. So health check your intercompany agreements for alignment. If you've got a more complex group, you'll almost certainly want to prioritize your transaction type. So that means going through that high-level scoping exercise to identify what are the key transaction types within the group which need to be reflected by agreements. Then prioritizing those transaction types by reference to perceived risk, taking into account things like volume of transactions and sensitivities with particular jurisdictions, and then actually health checking your agreements. #3, we've covered multiple times, but I can't emphasize too much. It really does require a cross-functional approach. So it means making sure that you or your clients are involving, or firstly identifying and then involving all the relevant stakeholders in your agreement design. And then point #4 is setting up regular review points for intercompany agreements so that you can avoid a Coca-Cola type situation where you have a portfolio of agreements that actually bears no reference to what the group is actually doing and how it manages its assets. So that concludes this webinar. Thank you very much for attending. I really appreciate it. I especially appreciate all your questions and comments. If you do have additional questions, please feel free to reach out to me or anyone else in our team. If you'd like a copy of these slides, please just drop me an email. I hope it's been of help to you, and if you have any feedback or suggestions as to future topics to cover as part of our monthly series, please do just drop me a line and I'll be really happy to hear from you. Thank you very much again.